the 1, 3, and 5 year time periods due to very strong equity markets and very strong treasury markets over that time period, but outperformed for the majority of the longer term time periods. Taking a look quickly at Q1, like I said, the returns have rallied pretty significantly in February, and the portfolio is up about 2% calendar year to date, quarter to date. So a pretty good start to the year after, I'd say a fairly strong year last year. If there's no questions there, I'll move on to slide 12. I won't spend a lot of time on these because I know we want to get to Dan. And these are the same charts that you've seen many times. Again, growth of a dollar chart on slide 12. This shows our portfolio versus both our benchmarks, implementation and long-term policy benchmark. You can see the orange line being the total pension portfolio. And we've added value over time, and you can see on the right side, as long as that orange line's above those other two benchmarks, we feel pretty good over the long term. So again, we continue to see that, even though we've obviously seen some volatility in that in the last year. Slide 13, again, takes a look at this, the same, our pension plan in orange, our long-term policy benchmark is in yellow, and then we added kind of the alternatives to see kind of the value add that bucket is creating. And on the 5 year basis, it's slightly behind it, but then on the 10-year basis, you can see that the alternatives has outperformed both the pension portfolio itself and the long-term policy benchmark. And again, returns aren't the only thing that we look at, obviously, with the alternatives as a whole. Each asset class within what we call kind of alternatives, which is the illiquid piece of the portfolio or the public equity and investment grade fixed income, it has a lot of roles within the portfolio, not just returns. But we always like to take a look to see, okay, is it adding value from a return perspective, even though it creates a lot of value from a diversification perspective and kind of reducing the risk for the portfolio as a whole. But again, we like to take a look at it in multiple ways, but this is one way that we do look at it. Moving on to slide 14. Again, this shows the contribution to total plan return for each asset class, and it just as a reminder, the right side of this shows the percentage, so the total plan return was 11.3%, and on the left side it shows the equivalent amount in earnings, so how much that 11.3% equated to, which was about almost $12.5 billion of earnings for calendar year 2020. And then below the total pension line, it breaks it down into each asset class and shows how much each asset class has contributed to that $12.5 billion in earnings, or 11.3% of return. So you can see the biggest drivers, as you would imagine, would be public equity, one of the biggest parts of our portfolio, and also had a very strong return of, I think, north of 22% for calendar year 20. So that was the largest driver in our earnings, followed by investment grade fixed income, again, our second largest piece of the portfolio, and it also had a very strong return last year of, I think, around 10% or so. So those are the two largest drivers in the contribution to the total plan and the earnings of the total plan, followed by private equity, who also had a strong year and created about $1 billion worth of earnings for the plan. Moving over to slide 15, our return attribution slide. So this takes a look at the total fund portfolio return versus our implementation benchmark. And as I mentioned earlier, portfolio return of 11.3% for the year, benchmark return of 11.27, so pretty close to flat, slight value add of 0.03%. You take a look at that value add and break it down into kind of how each asset class performed, which is the selection effect and the allocation effect, how our over and underweights versus policy affected that. And you can see, the value add was really driven by selection effect with a negative effect to the allocation. Similar story for the 3 and 5 year on the next two slides. Pretty strong value add on the 3 year of 0.5%. So portfolio return of 8% versus the benchmark return of 7.5%. And again, the majority of that value add was driven by selection effect. And then the 5 year, same story, 0.4% of value add, driven mainly by selection effect. Moving to slide 18. Again, this is our risk metric slide. It shows several different risk metrics. I think what is most pertinent to point out here is, if you look in the top left chart, the rolling volatility. Obviously, we talk about the volatility last year. Everybody saw the volatility last year. Huge drawdown in March, and a huge rally in the rest of the quarters, essentially. So we see those playing out in a lot of these numbers. So the rolling volatility measures the volatility of our returns. And you can see the 1-year volatility of about 9.71% was the highest we have seen really since the financial crisis. We got close to it in around 2012 time period where there was a lot of volatility, but we haven't seen volatility like this. And you can see if you look at that rolling blue line, that measures the 1-year volatility. You can see how low it got in the 2017 timeframe, and then how it spiked dramatically really throughout 2020. So certainly an interesting year last year, driven by a lot of volatility in the markets. And similarly, on the chart to the right of that, the rolling tracking error, that measures the excess return of our portfolio versus our benchmark and the volatility of the excess return. So, as we talked about before, significant outperformance when the markets drew down in March, followed by us trailing the benchmark essentially as the market rallied significantly and ending the year virtually flat with our benchmark. But in terms of the volatility of those excess returns, we saw quite a bit of that, which you're seeing really in that spike of all three of those lines there, the blue line, the 1 year, the orange line, the 3 year, and then the gray line, the 5 years. So you can see that, even though, if you look at it on an annual basis, there'd be virtually no excess return volatility since, we were virtually flat with the benchmark at the end of the year. So interesting to look at. Moving to slide 19. Again, this is another way we show kind of some risk metrics. Shows the upside downside capture, and then kind of the drawdown and how the portfolio reacts in different time periods. No huge changes since the last time. Again, we talked about we're more conservative than the benchmark, or we have been positioned that way. So you would expect us to have less upside, but better downside capture, where we wouldn't fall as much in scenarios where the markets are decreasing. And then on the bottom chart there, you see again, the green line shows the S&P 500, and then you can see our other benchmarks. It gets a little bit difficult to see in some of these time periods, but again, significant savings on the drawdown, where we're more conservative than obviously the S&P 500, but also the two benchmarks that we have, where the portfolio has not drawn down nearly as much as any of those other metrics. So it's kind of how we've positioned it, and obviously it leads to less volatility in our returns, which is something that we strive for as we're kind of setting up the portfolio. If there's no questions on any of that, I'll turn to slide 20. So again, this is our universe comparison, comparing ourselves to the BNY Mellon universe of public funds greater than 20 billion. And again, this is gross of fees, so I want to talk about that a little bit more. But you can see for the 1 year, our return gross of fees was about 11.6%, below the median of 11.93%. So we're in the 59th percentile. So again, strong year for returns in general. We're slightly below the median, but then when you look at our risk profile, really in all these time periods, we're extremely low risk, right? The 95th percentile for the 1, 3, and 5 year. So we've talked about that at length in previous meetings, so I don't need to go into that too much. But if you just think about the gross versus net, so last meeting we had CEM come in, and obviously they did an analysis showing we were the lowest cost in our peer group. So we had about, we were roughly 32 basis points, where the median peer was around 52. So there was about a 20 basis point savings of cost for our portfolio versus the peer. So if you think about that from the 11.93% median return and the NCRS portfolio of 11.6. So if you look at that net of fees, so we're obviously right around 11.3. But if you would subtract the 50 basis points of the median from the 11.93, that would be roughly 11.4, right? So we have a gap of 33 basis points here between where we are on a gross basis. But if you're looking at it from a net basis, we'd probably only be about 10 basis points, maybe slightly more than that, below the median. So if we had the ability to look at this net of fees, and again, the reason we don't is because a lot of our peers don't provide that, and it's not in the BNY Mellon data. So that's why we can't compare our net of fees to other plans' net of fees. But if we were, we would actually be closer to the median. So I feel even better about kind of where we sit from a one-year basis, right? 59th percentile, but we would be probably just below median or even closer to median with still having a extremely low risk profile. So I think that's an important point, given that we've shown that from a cost perspective and a cost efficiency perspective, we are really the lowest in our peer group. And just to be clear, these two peer groups aren't necessarily the exact same, but they are representative, and then it is what we would see. Because what CEM gets is a specific group that participates in their survey. What BNY Mellon gets is who they're custodian of and get that data. So it's roughly the same a number of participants, but they may not be the exact same. So I just want to be transparent with that. Moving on to slide 21. So again, Sharpe ratio is just another way we compare ourselves to our peers. It's a measure of risk-adjusted returns. So given our low risk profile, roughly median returns, we always look strong with this metric. And you can see for the 1 year, we're in the 6th percentile. So we are very high, very strong with our Sharpe ratio. And we're really around the top decile in pretty much every time period across the board. So again, we typically look strong on this given our low risk profile, but I think it's an important metric as well. Slide 22, again, this is our liquidity profile. I show this every time. It does not change dramatically from quarter to quarter. The top right shows kind of the liquidity in percentages, our liquidity allocation in percentages. The bottom right shows it if we added in our unfunded commitments to that, where that would be, just kind of as a hypothetical. What we really look at is on a total plan basis. Our goal is to have at least 70% in what we call level 1 liquidity, which is extremely liquid, stuff that we could get out of within a few days if we needed to. And as of the end of December, we have 76% level 1 liquidity level, so north of our kind of our policy minimum that we want to see. So no real concerns there. Slide 23, this is showing our net benefits by calendar year. So we paid out, if you look all the way in the blue bar on the right, we paid out just north of $2.3 billion net out of the portfolio last year. And again, we talked a little bit about how that's trending down slightly in the last couple of years, but due to the funding policy and what we expect with the liabilities, and obviously now that they've lowered the actuarial rate of return again, we would expect those numbers to trend up over the coming years. That orange line is not the trend line. It kind of looks like the trend line, but just to point out, that shows the annual payments as a % of the market value of the total plan. And so given that the net benefit payment number that we've been paying has been slightly decreasing, but as we've seen in previous slides, the market value of the plan has been increasing fairly significantly over the last several years. So we're seeing that decrease, right? We want to see that below 3% typically. That's, we don't have a lot of control over that number, frankly, but that's kind of the target that we monitor it on anyways. But you see that has dropped down significantly to be just above 2%, at like 2.2 or 2.3% at the end of December. So that's another good metric where we're paying out less as a percentage of the total market value of the plan. Moving on to slide 24. Again, this is our alternatives liquidity profile. Kind of looks at each alternative asset class and the cash flows for the previous year. You can see, if you look at the top right, you can see that we sent out about $2.7 billion in contributions over 2020 and received in about $3 billion in distributions. So realized gains coming back to the portfolio as some of these plans, some of these funds mature and realize some gains. So we're obviously a net cash flow positive with these asset classes of about $350 million last year. And the bottom, it just shows that in average monthly cash flow. So you can see the same type of statistics there. Slide 25, this is showing the valuation lag profile of the portfolio. So as we talked about before, some of our asset classes provide valuation on different time frames, right? So a lot of the private, more illiquid stuff provides it quarterly with a lag of 45 to 60 days typically. And, you know, some of our other structures provide it monthly, some with no lag, some with a 1 month lag. And then obviously all the public liquid stuff, it's daily valued. So we get that immediately and we know what that is. So you can see the vast majority of our portfolio, about 76% of it is daily valued. And then you have roughly another 7.5% that is valued monthly, either with no lag or 1 month lag. And then you have roughly, 16% that that's quarterly valued. So get a sense of kind of how there is a lag to some of this valuation. We talk about this with some of the alternatives where, if there's a big volatile market where we've seen last year, those won't be reflected in some of our private equity numbers and our real estate numbers until 3 months later, essentially. So I'll turn it back over to Jeff to finish the deck.
Okay. We'll flip to slide 26, which has the asset class net of fees performance, kind of highlighting, focusing on the 1 year number. Obviously, the strength we've touched on multiple times here on public equity. Also worth noting that return to the benchmark and the excess performance that you saw in the other data set. So kudos to Rhonda and the equity team on a tremendous year. Private equity also did well as IG fixed income with pushing up towards 10% numbers. You'll see, I'm going to point it out in the next slide as well too. We always talk about timing and stuff with public equity and private equity and lag numbers. You kind of see where private equity is a little behind public equity number. We'll look at a little bit of that on the next slide as well too, that timing difference we see often. On the weaker side of things for us for the year, negative returns, we had inflation sensitive. Of course, we had no inflation really to speak of here, starting to show up now, but during that time period, it didn't do well. Core real estate pretty much just flat, and multi-strat struggled there as well. If we flip over to slide 27, kind of our heat map, I guess you'd call it, slide. So I'll point out while I was referencing the public-private equity, if you focus on the columns for 2017 and 18, and you'll see where public equity is much higher than private there for that year, a big gap. And then in 2018, you see it flip-flop at that timing where private equity is really up top and public equity is there. So just kind of points to that thing we always say about it's really difficult to think about those two asset classes and measure them on short time periods, public versus private. And then the other notable thing that really stuck out to me is if we look at 2019 and 20, we've got 2 straight years where we see the two public markets in the dark blue in public equity and the yellowish tone there in investment grade fixed income in the top half of the returns. And you won't find that anywhere else on the chart. I dare say with where we are in rates and then heading back higher, we probably won't see those two up there together again for a while. Looking forward to slide 28, our incremental and new and incremental commitments. You'll see nothing new on there since our last meeting. An update on the right on our unfunded commitments in the private asset classes. That number is now down to $5.2 billion. It was 5.4 when we sat down last time. So we continue to see that trend down. And on slide 29, something we discussed at the last meeting, we were going to provide an update on it. So this just has our private asset class commitments over time by year here. And before we had only the yellow line in there, which is the absolute number, the 5.2 billion, which is on the left-hand axis. And that really loses some of its relevance as we go into longer time periods because the AUM has changed so dramatically on what the pension plan size is. So we think a better way to think about it is what is the percentage of the overall plan that is unfunded. And you can see in that dark blue line up top, that number has really plummeted down as we pulled down some of the concerns the Treasurer had coming in. And so now we're really at a level that we haven't seen since 2006 area as far as that goes. So just a good data point on how different things are in those markets versus, not too long ago. Looking forward on slide 30, our asset allocation history, again, no major changes from what we had seen before in the past years. You see bumps in since 19 or so in the cash number and public equity, which we talked about in the asset allocation being a little lower in our allocation model. On slide 31, our exited investments. The only update we have here in early January was a $3 billion redemption on the public equity side from BlackRock. And then lastly, on the final slide, on slide 32, which has a breakdown of our top 20 investment managers. Again, the internally managed programs, they lead the way there at over half of our assets. That number was a little higher, 52%. That's not because, it's really because we saw a big denominator change in the growth in equity overall. But the total that we have there is actually a little higher that we have because of the growth in internal equity that we've seen in the market. So no material changes in that data set, but always good to take a look at where we stand. So, any questions on the performance review? We'll do that. Okay. If not, we wanted to bring up one topic that that's been broached a little bit in the previous meetings, is we've talked about the ALM study and doing that, and wanted to make all the committee members aware that we got the go ahead from the treasurer on that. So we started that process. Ultimately, that leads to us a fresh look at asset allocation as part of that process at the end. So we'll continue to keep the committee members updated on that as we move along throughout the year. Okay. All right. I think the next thing we had on the agenda was Mr. Clifton, and we'll check and see if he's with us yet.
I am here. Can you hear me okay?
Yeah, we can. Be good.
Great.
Before Dan gets started, I just wanted to highlight everyone. We've been fortunate to have a relationship with Strategas for a number of years now, and it's safe to say that the time we get to spend with Dan, as a matter of background, as the head of policy research at Strategas, is one of the favorite times I know for the staff and the people that get to enjoy that conversation. So I know the team's very much looking forward to your thoughts and the crystal ball of what lies ahead. So with that, we'll let Dan take it off. The committee members should have received an email with the slide deck for that as well separately this morning too, just to make you aware. So, and Dan, if you'll kind of walk us through, we'll be glad to walk through the slides. If you'll prompt us, we have a team member here that can update him here in the room too.
Okay, that's great. Well, first, thank you for having me today. It's great to be here. I come here with a great amount of humility. We were together a little bit over a year ago, and we were fairly optimistic on what we saw happening on the economy. We knew that there was going to be a presidential election, but almost a month after I had left your office, we were in a complete lockdown due to the pandemic. And 2020 was like no other year we're ever going to see politically. And I think that has important implications for governing on 2021. So what I want to do today is walk you through just a recap of 2020 and what that.
Dan.
Yes.
Hey, this is the treasurer. I know if you be just a little louder, that'd be awesome.
Great. I'm going to change my mic. Thank you. I appreciate that.
Thank you.
Can you hear me better? Can you hear me better now?
No, it's worse.
Worse. Okay, we'll try again. Hold on 1 second.
We're paying you by the minute, so we want to make sure we hear every minute.
I will speak louder if you can.
All right. That's great. Go ahead.
One, two, three, four. 1, 2, 3, 4. Can you hear me?
Yeah, that's a lot better. Thanks.
Great. Well, good. Thank you again for having me today. If we could turn to the first slide. This is a chart that I've shown you repeatedly, and one I think has even greater significance today. We've just had our 8th federal election since the financial crisis, and the voters in this country have removed the party in power in 7 of those 8 elections. We've gone back more than 100 years to find if we have had any type of this level of political volatility, and the answer is no. Really, this is the most political volatility we have seen in the United States since the end of the Civil War. We had an all Republican government. We've had all Democrat. We've mixed it up. We rolled the dice with Trump in 2016. And I do believe that much of this political volatility stemmed from economic volatility, the very subdued economic recovery after the financial crisis. Unfortunately, that economic volatility is also now turning into social volatility. And I think explains a lot that even if the economy starts to come back, this political polarization will continue in the US, as much of this political polarization is now starting to divide on political issues. We can turn to the next slide. This was even more exacerbated in 2020. We had 4 transformational events happen in 2020. We went back and said, have these 4 transformational events ever happened over the last 100 years? And the answer was no. Number one is that we had a recession. Recessions generally are transformational events. They lead to an acceleration of technology. They also have important social consequences. 2, we had a pandemic. The number of Americans who passed away last year was up 15%. On a normal year, you usually get about 1 or 2%. And then we have the social and economic cost of the lockdowns. 3, we had social unrest. And 4th, we had a presidential election. The closest that we have ever seen to something like this happening was 1968, where we had 3 of these 4 events happen. We had a pandemic, we had an election, and we had mass protests. The recession didn't come until 1969. But that's the closest that we've ever had. And I think there's a lot of similarities today between 1968. President Biden's tax plan is very similar to the 1968 tax increase. The war on poverty is very similar to what you see being put forward in the stimulus measures. And you are actually starting to see concerns building about inflation, which is something that was long lasting after 1968. So this is something that hasn't happened in 52 years. And I think it's going to have important implications for governing moving forward. We can look at the next chart. What we see here is that, like 1968, the economy was not the sole issue for this election. If you actually looked at the economy, President Trump should have gotten about 50% of the vote. In fact, he got 47% of the vote. But this is probably one of the most profound charts that I've ever seen in politics. It's the number of swing state voters concerned about COVID and Biden's lead in the swing state polling. As COVID got better, Trump's numbers improved. As COVID's got worse, Trump's numbers deteriorated. And what this argues is that you had a situation where Trump's numbers were largely dependent on COVID. And as a result, the mandate that Joe Biden got from this election initially is to get COVID under control, a much more limited mandate, which I'll talk about up until the Georgia election. So this is the driving issue of the U.S. voters. In 1968, you had a similar situation where the Democrats on the economy should have won. But due to some of the social issues that were going on, the Democrats actually won. And there are very few elections in U.S. history where the economy is not the sole election determinant. Look at the next slide. Here we look at just the popular vote and the electoral college margin in the tipping point states. If you remember a year ago, I came to you and said, Donald Trump could win this election even if he loses the popular vote by 3 or 4%. He could still win the electoral college. Here you see Hillary Clinton won the popular vote by 2.2%. Joe Biden essentially doubled that, winning the popular vote by 4.5% and just putting the electoral college out of range for President Trump. If you look at it on a popular vote, aggregate vote margin, Joe Biden got 83 million votes, the most for any president candidate in U.S. history. He also won by 8 million votes. That's a very sizable lead in the aggregate. What we like to look at is the tipping point states, however. Hillary Clinton 4 years ago lost the tipping point states by just 77,000 votes. In 2016, those tipping point states were Wisconsin, Michigan, and Pennsylvania. This time around, the race was even closer. Donald Trump lost to Joe Biden by just 65,000 votes in the 3 tipping point states of Arizona, Georgia, Wisconsin, and then the Nebraska congressional district. So you had an election which was even closer on an electoral college basis in 2020 than it was in 2016. And if you had a football field on a Sunday afternoon change their votes the other way, Donald Trump would be president. I don't think many people recognize the closeness of this election as it got bogged down on other issues. If we could turn over to the next chart, this is not some sort of statistical fluke. This happened with the highest voter turnout since 1900. It's remarkable that you're talking about 160 million or close to 160 million Americans voting, and the difference coming down to about 65,000 voters. That is an astonishingly close race, and one I think has important implications. If you turn over to the next slide, usually you get big waves when you have a president who gets elected in a major crisis like the pandemic. You saw President Obama win by a large margin and be able to win a lot of Senate House seats in 2008. Reagan in 1980, a similar situation. FDR in 1932, and Harding in 1920. Very large vote margins, large coattails in the Senate and House. That didn't happen this time. On election day, the Democrats likely picked up one Senate seat, turned out to be 3 because of the Georgia election, and he won the popular vote by 4.5%. Interestingly, Democrats were supposed to win 10 to 15 House seats, ended up losing 13 House seats and losing 1 governor's seat at the same time. And so what you have today is a 50-50 Senate, the smallest majority for a new Democratic president since 1885 with Grover Cleveland. And if you turn over to the next slide, it is the smallest Democratic House majority that we could find on record going back 140 years. So you have an extremely close presidential race, a 50-50 Senate, and really just a 3 or 4 seat difference for Nancy Pelosi to get the votes in the House of Representatives. That's as razor sharp as it comes. And it's very similar to the margins that George W. Bush had when his presidency started in 2001. He had a 50-50 Senate. He had a 3 or 4 seat majority in the House, very similar to where the Democrats are today. Turn over to the next chart. Despite the election producing such a divided, polarized environment, new presidents generally get a lot done very early in their administration. And as I mentioned, George W. Bush had very similar margins as Joe Biden will have, and he was still able to get a lot done, particularly in the first 6 months before Jim Jeffords changed parties. And what you see here is that presidents usually get a lot done in their first or second year. And that's what Joe Biden is so aggressively pushing for, getting something done. And I got to be honest with you, the Democrats were anticipating that they would have a Republican Senate all the way up until a couple days before the Georgia election. And so they weren't anticipating much. And the Democrats believe the Georgia election produced a mandate for them, given that you had a 3% swing in the Georgia elections in a 60-day period, where the Democrats went from losing Georgia to winning Georgia and doing it over a 60-day period. They see that as a mandate for greater fiscal policy stimulus, and explains why the Democrats are being so aggressive on fiscal policy stimulus. If we can look at the next chart. Most presidents get broad fiscal policy discretion once they come into office. This is just a simple chart of all the previous presidents and the amount of fiscal policy that they get enacted in the first year, and what that 4-year average is as a percentage of GDP. So I would look at the last 3 presidents as a good guide. They generally are getting about 1% of GDP fiscal policy stimulus. Joe Biden's going for 5. So this is a much larger fiscal policy proposal that we've seen historically, and it's being done due to the coronavirus impact. There will be health money in there, there'll be education money in there, there'll be money for state and local governments, and there will be money there for U.S. consumers. But when you pull it together, it's about 5 times the size of what a new president usually gets upon coming into office. And I just want to make this point. In December, before Biden took office, we were getting about $900 billion of additional fiscal policy. So everything Biden is putting forward and Congress is acting on this week is really just an addition, an add-on to what had been done in December. If we could turn over to the next slide. This puts it in context. This is a comparison of fiscal policy relative to the financial crisis. If Biden gets everything that he wants, which he's close to getting, it would be about 11% of GDP fiscal stimulus this year. Interestingly, it will be more fiscal policy stimulus this year than last year at the height of the coronavirus and the unemployment rate. If there is no stimulus package, the budget deficit was expected to go from about 15% of GDP last year to about 10% of GDP this year. But if the Biden plan passes, you will see an increase in the federal budget deficit from 15% of GDP to 16% of GDP this year. So this is a pretty significant fiscal policy stimulus that is being put through. What the administration is targeting is unemployment. And as long as unemployment remains high, even if GDP is strong, they're going to continue to keep their foot on the lever on fiscal policy. If we look at the next chart, this is our strategic stimulus basket. These are the companies that are most levered up to fiscal policy stimulus. It's consumer, it's COVID-related healthcare names, it's companies that insure state and local government bonds. You can see that they continue to outperform a very strong equity market. I think the biggest focus of this fiscal policy is that you're seeing a broad improvement in consumer discretionary as Congress just basically floods the system with money to consumers. You remember in Georgia, there was a big campaign about providing $2,000 checks. You will see about $1,400 checks here. You also see an increase in the child credit to $3,600 per child. So really heavily focused on the U.S. consumer, and the stocks that are levered up to this are starting to respond. If we can look at the next chart. This just breaks down the allocation of that stimulus in terms of timing and where that money is focused. And what I would argue is that this stimulus is extraordinarily front-loaded. It's focused on consumers and government, but it is also focused in areas that are already doing well, and I think is poorly targeted to unemployment. We estimate that $1.2 trillion will be distributed from the federal government to its intended recipient within the first 6 months of this bill passing. Very front-loaded, given that it's a $1.9 trillion package. And this chart breaks down, the chart on the right breaks down how that money is allocated. $700 billion to consumers in 6 months. As you know, consumers received $130 billion in the month of January, and retail sales were up 5% because of that. Now you're talking about delivering immediately $400 billion to consumers at a time when the economy is reopening. There's also $379 billion for state and local governments. Tomorrow, we will get a new GDP report. That GDP report is widely expected to show that state and local governments produced their first budget surplus in 42 years, given the strong recovery in state tax revenues and given that the federal government provided massive amounts of federal aid to state and local governments. And so the consumer has relevered, state and local governments are relevered, and now they're going to get more than $1 trillion distributed to them over the next 6 months. And so when I talk about being poorly targeted, that's really where the basis of those ideas come from. If we can look at the next chart, this is the personal savings rate. American consumers have $1 trillion in savings already. Now you're going to get more money. And this chart on the right is that state and local budget surplus. Of course, this includes federal aid, but it is the first budget surplus in 42 years for combined federal and for combined state and local governments. We can look at the next chart. This is, just move back. So this is just one example. I just put it in here. Know your audience. We track North Carolina and every state tax revenues. And you can see that North Carolina is already above its pre-pandemic level in terms of tax revenue. This is true for about 25 of the 50 states. California is the strongest of all states, where they're up about 5% on a year-over-year basis. We believe, given the strong stock market in 2020, given the employment recovery and retail sales recovery, you're going to see a broad improvement in state taxes. If we can look over to the next chart. This chart is showing you the sheer magnitude of what we're trying to do. I would argue that the CARES Act that passed in late March was very effective in ensuring some sort of security for Americans as the lockdowns went into effect. We had a 15% unemployment rate, and on top of that, we had basically a big rise in COVID coming. We provided $2 trillion of aid, and fortunately, the unemployment rate has moved from 15% to 6.3% today. Congress is now debating whether to provide an additional $1.9 trillion of aid on top of the $900 billion that passed in December for $3 trillion of aid, while the unemployment rate is 6.3%. If you watched Fed Chairman Powell yesterday, he continually repeated the idea that 10 million Americans are out of jobs, and this is what the Fed is going to be targeting overall. But it just seems just unbelievable how much stimulus we're providing, even as COVID is improving and even as the economy is improving. If we could look at the next chart, please. This just gives you an example of what I'm referring to. We did $900 billion of stimulus in December, and then we got retail sales and industrial production on February 15th, and the expectations for GDP are now close to 10%. If we do this stimulus, you're going to get another big distribution of stimulus money in April. You could be looking at 2 quarters of really strong blockbuster growth, close to 8-9%, somewhere in that range, which is really significant, given the bond market is, the 10-year Treasury was at 1.2 just a week and a half ago. We're also seeing that we're going to get close to herd immunity on COVID right around the first week of May. This is the combination of people who've gotten immunity from a past infection, from the vaccines, and from the combination of the two. We believe the U.S. economy will reopen before herd immunity happens. As more people get vaccinated, they start to take out greater risk and they start to become more mobile. And that's really been the big trade in the market over the last couple of weeks, is this acceleration of the reopening. And I like to say the bond market is declaring COVID-19 over. That might be a bit premature, but that's essentially what's happening. And if we can look at the next chart.
Hey, Dan,
this is the distribution of
Dan.
vaccines. We're really starting to ramp up here. Pfizer yesterday was talking about having a surplus of vaccines in Q2, that at any point, somebody could walk into a Walgreens or CVS and get vaccinated as we get into May and June and July. It is impossible for policymakers to justify lockdowns and school closings if you can walk into a CVS and a Walgreens and get a vaccine at any point. Israel is the great example that's being used. About 80% of the Israel population is vaccinated, and you've seen a really dramatic decline in hospitalizations and deaths as that started to go through. Some of that could be seasonality. Correlation is not causation, but our anticipation is that 95% of the vaccine, 95% effectiveness of the vaccine is proving true in a large real-life example like Israel. I think we're going to have similar results here in the United States. We can look at the next chart. And as a result, what you're seeing is the U.S. economy is starting to price in really big financial U.S. economy reopening. This is just the yield curve, the red line, the 210 spread on treasuries, and the strategic reopen basket relative to the S&P 1500. It's amazing how well these two have correlated together. And I would argue that most of the bond market response has been due to this reopening, as evidenced by this chart itself. What's included in here: retail, travel companies, any type of company that's related to the reopening. And I would just point out that this strategic sports basket, which is my kind of favorite, we did it more as a fun item. But if you really believe that COVID is starting to wane here, you're going to go to sporting events, and these stocks in here represent that, whether that's the Atlanta Braves or Madison Square Garden or Churchill Downs. You're seeing a very broad outperformance in these stocks as the market begins to anticipate a reopening. And I'm showing you this because this is all happening. This is good. When it happens, you'll see those low wave service-oriented jobs start to come back, particularly in the travel industry. You really don't need stimulus for this, and you're putting stimulus on top of it. So if we can look at the next chart. And so there's this theme building here in the market called the risk of overstimulation. This is just a chart of the 10-year yield in copper. Copper has historically correlated with the 10-year yield over long periods of time. And if this chart is right, it's suggesting the 10-year treasury should be closer to 2%, not 1.3%. Now, I don't know if treasuries are going there, but it's just something that's pricing in. And you're starting to see expectations for better inflation starting to price into the market. And when I say inflation, I don't mean like big inflation, but just that we're getting to about 2.3% inflation over the next 5 years. And that would be the highest that we've seen since the financial crisis. And so the way that I've been thinking about this is at the very least, you could be seeing the end of disinflation that has persisted for so long after the financial crisis. And that's why you're seeing movement in energy and financial stocks that get associated with that. If we could turn over to the next chart. Even with all this stimulus, you're starting to see the Biden administration pivoting towards another stimulus package as soon as this one's over. You're going to hear a lot about this in the month of March, and it's different than the type of package that we're doing now. Right now, we're talking about doing income replacement, more money to consumers, more money to state and local governments, more money for the vaccines. Here, what Biden is talking about is doing another $3 trillion of infrastructure and climate change spending. The market is beginning to price this coming into effect, as evidenced by the Strategic Highway basket, its relative outperformance. And I just start to worry that you're reducing all of your political capital on the income replacement bill. It's going to be harder as we get in the summer to do some sort of large-scale infrastructure package. You're going to have higher interest rates. You're going to have a better economy. You're going to have a $3.5 trillion budget deficit. I think it's very unlikely that we're going to be able to pull off that $3 trillion of new infrastructure. I look at what's going on in Texas with the grid that provides a catalyst for something to get done, but my sense is that it will be much more smaller and shorter lasting. I call it camel nose under the tent. Instead of doing a 6-year infrastructure package or 10-year infrastructure package, maybe you're doing a 2 or 3 year infrastructure package. And as a result, it's probably not going to be as bullish. But I show you this in the context of rising inflation expectations. Congress coming out in the month of March talking about doing $2 or $3 trillion more of spending. I'm not really sure that that's going to be possible, but at least that's where the debate will be. If we turn over to the next slide. You're starting to see some weakness in some of the climate change stocks here. These are Democratic stocks related, or stocks to climate change that were in our Democratic portfolio. You've seen them started to underperform. Some of that is just the market anticipating higher interest rates. Some of these were speculation, but some of this is the belief that as the reopening happens, it will be harder to get large-scale green energy infrastructure through. I do want to make one comment, and this is important because Biden is really the first climate change president the United States has. He's treating climate change very differently. And while the spending amount that he's going to get is less, there's a lot that he can do on the regulatory front that I think will be important. The SEC making companies disclose all of their carbon emissions. You're going to see the Federal Reserve instituting climate stress tests on the banks. ESG funds being permitted in 401ks. So there's a whole of government approach being put forward on climate change that is going to start to change the nature of how the issue is discussed in the United States and the requirements placed on U.S. companies in dealing with climate change. We could turn over to the next chart. Obviously, the next package will not be all deficit finance. There will have to be tax increases associated with that. And the low-hanging fruit of tax rate increases will be an increase in the top marginal tax rate and an increase in the corporate tax rate. President Trump's tax reform reduced the effective corporate tax rate by about 700 basis points, so it's pretty significant. We expect that the Democrats will be able to get that corporate tax rate up to about 25%. It's about a $40 billion increase in taxes that would reduce S&P 500 corporate earnings. And we tried to provide a chart on which sectors in the S&P 500 have had the lowest and highest effective tax rate changes since the corporate tax change went into effect. One other key point here is that the Democrats are likely going to impose a tax on U.S. multinational foreign source income as well. That obviously affects biotech and technology companies, and so that's likely going to be included. We can turn over to the next chart. We do anticipate that there will be an increase in the capital gains tax rate as well. Higher capital gains tax rate means lower capital gains tax realizations historically. We think they'll be able to get the rate to about 25 to 28% if they're successful in getting more infrastructure and climate change spending as a way to pay for this. So this has a broad implication on financial markets. It also would impact state tax revenues, because if you do raise the capital gains tax and there are fewer realizations, federal and state government tax collections go down. I would anticipate that as this tax bill gets debated this year, you will see high net worth financial advisors suggesting to their clients to take some gains at the lower rate before the higher tax rate goes into effect. So it could actually have a positive effect on next year's capital gains tax revenues for the state of North Carolina, but then you get a drag in future years as you just ultimately see lower realizations. And then if we look at the final last chart, which is just a review of everything that Biden put forward, and I just put this forward because this is very much like what was put out in 1968 as part of the war on poverty. I don't believe all of these tax changes will go into effect. And our base case is that the top marginal tax rate will go into effect at 39.6. You'll probably see some sort of haircut to the value of deductions high income taxpayers can take, higher capital gains and dividend tax rate, higher corporate tax rate, higher taxes on foreign and international income, and maybe a higher estate tax rate. We do anticipate, with a Speaker of the House from California and a Senate Majority Leader from New York, that there will be a big push to reinstate, at least partially, if not fully, the state and local tax deduction. I think one of the great stories that's happening right now is the massive wealth migration out of high tax states and into low tax states, which has been going on for 30 or 40 years, but has actually been accelerated due to work from home and the haircut on the state and local tax deduction. And so the golden goose of taxpayers in California and New York are leaving for other areas, such as Florida, Texas, Tennessee. North Carolina is probably a beneficiary of that. And you're probably seeing it in more congestion in your streets once the economy fully reopens. But ultimately, the Democrats are going to try and stem that. So that's our review of the policy landscape. This is an aggressive agenda for a 50-50 Senate. My guess is that the Democrats are going to be successful in getting at least some portion of this $1.9 trillion package passed and be able to do it next month. There's probably going to be hiccups in the next couple of days, including today, when the Senate parliamentarian rules what can and cannot be included in the bill. But there is a broad support in the Democratic Party to get an early win, get that early win on fiscal relief, and they're likely to do it. Their challenges will get much harder as we get mid-year and the economy reopens. Thank you for having me. It's an honor to be here, and I look forward to any questions that we can talk about these issues in greater detail. Thank you.
Thank you, Dan. First, any questions from our committee members? Okay. If not, I'm going to hop right in with one then.
Can our committee members hear us?
No questions?
Yes, we can hear you. I can hear you.
Can hear you.
I'm still trying to process all the great information.
Good.
So I've got a couple, Dan, Jeff. I guess first off, does the one chart you showed early on with that big mortality spike, does that have any material impact on the funding status of things like Social Security or pension liabilities or anything like that you see?
I'm sorry, my speakers are not working. So if somebody was talking, I couldn't hear. I apologize about that.
That's right.
Okay, I can hear now. Sorry.
Okay, great.
Much better. And Jeff, if somebody was talking to me while I was speaking and I didn't hear you, I apologize. I just, for some reason, my speakers were off. Thank you.
No problem. So the question was, in the one chart you showed on, I think it was slide 3, with the big mortality spike that we saw.
Yep.
Does that have any material impact on the funding status of things like Social Security or on pension liabilities, or what do you see from that dramatic spike number there?
Absolutely. So the first, it's a great question. And, the first thing I have to ask myself is, was this a pulling forward of fatalities in the United States? And I think the answer to that is yes, because what we've noticed is that people who have to go to the hospital or unfortunately pass away from COVID either were already up there in age, or they had some pre-existing condition that COVID mixed with. And so my sense is that this year we're going to have fewer deaths than we had last year, and ultimately it may lead to a lower trailing of deaths. And so if this is just a pull forward, that's different than having a one-time spike and then we go back to the normal levels. Still, your question is a good one, because if somebody was scheduled to pass away 5 or 6 years ago and they passed away this time, that will begin to change the actuarial tables on Social Security, Medicare, and pension liabilities. In context, Medicare and Social Security are pretty messy right now, given that we're running trillions of dollars of deficits. And so, it may be offset by all the spending that we're doing here, but I do think that it will wind up leading to improvements in the funding status of Medicare and Social Security when the actuaries start putting out their reports. I think that first report comes out in April, and then obviously in successive years based on the trend that's going to come from that. On state pensions, I'm a little bit less sure, because you would have to see, are the people passing away, retirees in the state system. I just wouldn't have that level of information. But because Social Security and Medicare are quite broad, and we know where the concentration of deaths have occurred disproportionately in the over 65 range, and definitely at the over 85 range, that suggests that there's going to be some changes in the actuarial tables.
Okay, thank you.
Any other questions? Go ahead.
I got more if we got time.
Keep them coming.
One is the polarization that you talked about, which is so evident that we see in politics now. What about the polarization within parties? For example, on the Republican side, where there's chatter about splinters off of different factions and things like that. I guess, how realistic do you see that as a possibility, and the impacts and kind of thoughts around that whole topic?
It's a great question. And, if you think about my presentation last year, I think it was like the second slide was that we really have 4 political parties in the US right now, 2 in the Republican and 2 in the Democratic side. The Republicans are going to be a lot more obvious to you just because the president's going to speak at CPAC this weekend. And there's a pretty open fight going on between President Trump and Senate Majority Leader McConnell. And, there's a question. I think I looked at a poll yesterday where half of Republicans would join another party with Trump if he created his own political party. So that is evident and there. It's going to be very visible. What you are seeing in the reconciliation bill right now is this massive divide happening in the Democratic Party, but it's happening behind the scenes. And so today, we expect the Senate parliamentarian is going to rule on whether the minimum wage can be included in this Senate reconciliation bill. I've worked on 6 or 7 reconciliation bills in my lifetime, probably more than most people. I have a pretty good understanding of how reconciliation works, and the minimum wage just does not qualify for reconciliation. The Democrats were telling us last night that they are not going to vote for Biden's stimulus plan out of the House if there's no minimum wage included in there. That's an astonishing statement if that happens. And by the way, everything that we've seen over the first month of the Biden presidency is that the Democrats are willing to compromise to get this first bill out. And I do believe that they will get a first bill out, but there could be volatility here when the progressives on the Democratic side say, we demand a minimum wage and we demand that that minimum wage be included in this bill, or we have to repeal the filibuster. Then you go over to the Senate side. You think that's going to fly with Senator Sinema in Arizona? Even Joe Manchin is talking about $11 minimum wage. So let's just say that the parliamentarian allows the minimum wage to be included. Then you're going to see Manchin say, well, I don't support 15, I support 11. And that's going to lead to a pretty big fight. So these fissures in the Democratic Party have been less evident, but I see it in my day-to-day life on kind of what's happening behind the scenes. And I believe Biden's going to get this package passed, because ultimately the progressives are going to have to accept no minimum wage for a larger package. And the moderates are going to have to accept a larger package with their demand to get no minimum wage. And that works on the first bill. It doesn't work on the second bill. I mean, we're getting a second bill and it's going to be like, oh, we want a carbon tax, we want a financial transaction tax. And so these fissures are going to be a little bit more evident as we get closer to the summertime. Now, let me take a step back. By April, under Obama and April under Trump, you really started to see the opposition party rally against the incumbent party. And that's important because the Republicans were pretty divided in early 2009, and the Democrats were pretty divided in early 2017. I live in the Washington, D.C. area. My neighborhood is probably one of the most anti-Trump neighborhoods you have in the United States. There's a lot of government officials, people who work for international organizations on my block. And I got to tell you, they didn't have much of a life for the last 5 years. They basically just complained about Trump all the time and how he was destroying the country, right? And, 2 weeks ago it snowed and everybody wanted to talk about the Super Bowl. And it was like a striking moment to me, because this is how it happens. People who didn't like Donald Trump, their life is going back to normal now. Oh, Biden's there. I don't need to worry about politics. I'm going to go back. I'm going to have hobbies. The economy is going to reopen. They want to talk about football. Okay. And what's happening here is that the Republicans are looking at what's going on and they're like, wow, these are some really bad policies being enacted. Like the ending of the Keystone Pipeline, which just put 18,000 people out of work. Like a monthly payment per child, which looks like universal basic income as part of the stimulus. And so what I see is that the Republican voter is getting energized around its opposition. And I think that's why you'll see some of these fissures in the Republican Party begin to dissipate as you get closer to the end of this year and into next year. But if the Republicans remain divided, it will be a very difficult process for them to overtake the House, as you normally see in the first midterm year election. I mean, the average number of seats a midterm election produces is 28 seat loss for the incumbent president. And on top of that, there are 17 Trump districts represented by Democrats, and the Republicans only need 5 of them to win the majority. So the majority is very much in the reach of the Republicans. They're going to determine their own fate if they want to fight yesterday's war, or if they want to have control of the House of Representatives and stop these policies from happening. And my experience is that usually the opposition party begins to put their divisions aside until they get power, and then they become apparent. That's what the Democrats did.
Thank you.
Thanks. Any other questions from board members or from IMD staff?
Great.
Okay. Dan, thank you for joining us. We look forward to seeing you in future, in person someday in the future. We appreciate the insights that you've given us, and thank you for attending.
Thank you. I think we're closer to seeing each other in person today, and we're probably just a few months away from a good, strong reopening. Thank you for having us. It's an honor to be here. We look forward to working with you and seeing you in the future. Appreciate it very much.
Thank you.
Thanks. Our next presenter is Ron Funderburk, who's going to talk about opportunistic fixed income and other issues. So
Inflation today, Trick.
okay.
His other side of his role.
All right. Thanks.
Good morning. Typically in a room you can hear echoes of people responding back, but given we're in the COVID environment, I would just assume that everybody's having a good morning and giving out positive vibes. It's my pleasure to talk to you about the performance of the inflation-sensitive portfolio over the last year, and then we'll also talk about the performance of the inflation-sensitive portfolio over a longer time period and the roadmap that we have traveled to arrive where we are today. In addition, we will provide some color on the current inflation backdrop and different macroeconomic factors that we deem important that may make an impact on the direction of inflation on a go-forward basis. And then additionally, we'll conclude with gaps in our portfolio or opportunities in our portfolio that we deem suitable for the future in the portfolio. And then I'll start with the first slide here. This is for, given the fact that there's a significant amount of change with the board over time, just wanted to recap what the role of the inflation-sensitive portfolio is. It's to provide some degree of protection against risk associated with inflation. And last year, I think we had more risk associated with deflation than in inflation. I think years previously, 2019, 2018, we were nearing the end of a business economic cycle and worried about inflation rearing its head. But we also need to generate attractive absolute returns, competitive relative returns, importantly, diversification, and liquidity when the portfolio or broader pension fund is experiencing the impacts of inflation. And we'll talk to you a little bit about how we're trying to achieve all of these things. The next slide, the historical allocation by sub-strategy. As you can see here, the colors look markedly different from the inception of the portfolio to the end of the portfolio. Why is that? That's because the inflation-sensitive portfolio has had 4 different phases, 4 different guidelines since the inception of the portfolio. Initially, the inception of the portfolio, we were going to focus on publicly traded natural resources and commodities and energy-related assets. So that's where you see a significant amount of orange early on. And over time, when we get to the 4th phase, which was started in July of 2014, we made a heavy emphasis towards increased diversification and diversifying towards real assets and other diversifiers that would have less sensitivity to deflationary environments. As we all know, energy has the potential to protect against unanticipated inflation expectations, but it also has the ability to correlate poorly with negative changes in GDP and expectations of deflation. And so that's the roadmap that we are currently on, and it has been actually a really good pivot for the plan starting in July of 2014 to increase exposure to real assets and diversifiers, infrastructure-related investments, and other real asset lending opportunities, because it's taken down the equity risk associated with the portfolio and the commodity risk associated with the portfolio. Moving on to the next page. This slide shows the historical commitments over time since inception of the portfolio, dating back to 2006, 2007, where there's a heavy emphasis on timber-related assets. And then we move forward where you see a color variation where we focus on publicly traded natural resources, and we focus on other real assets and diversifiers moving forward, starting in 2013. And you see in 2020, we did not make any new allocations or new commitments to inflation-sensitive asset class, again, primarily due to some of the deflationary expectations or things that we experienced last year, but that also doesn't necessarily show the truth. Last year, we drew down $300 million in new deals with regards to some of our secondary managers that we work with. There's a group called Landmark and another real asset diversifier group that called approximately $250 million of capital in aggregate last year. But last year, we also experienced $560 million worth of distributions last year. So I thought that's something noteworthy to talk about. Last year, for the calendar year, we were $320 million net positive for the asset class in a year like last year. I thought that's something noteworthy. And you also can see that our unfunded levels moved from $3 billion in 2014 down to $1.4 billion on a go-forward basis. And today, we stand at approximately 4% of planned assets, and we're reasonably underweight. We're reasonably underweight our target, weighted by $1.4 billion. I'm going to move forward to the next. This slide shows our allocation. Again, we are diversified. It's almost like a third, a third, a third. It's not exactly a third, a third, a third, but you can kind of see how one might get there. And you can also see the orange, the publicly traded natural resources, which used to be 100% of this pie, is now only 4% of this pie. And you can see that with the drawdown that one experienced last year in commodities, that was a good decision if drawdown risk is something that you're worried about. And we'll talk about performance coming up. But you can see that we're materially diversified across private natural resources, publicly traded natural resources, inflation-linked bonds, and other real assets and diversifiers, which we think the green area still has further room to grow in an area where we can provide vintage diversification and strategy diversification for the plan. All right, next slide, performance. Last year, our performance for the portfolio was down 3.5% relative to our benchmark being up 0.7%. That is a big difference, and I'll have an opportunity to explain that. But I want to talk about the longer-term performance first. As you can see, over all time periods, with the exception of the one-year period, our portfolio has outperformed its benchmark over 10, 7, 5, and 3-year periods. And then I want to break it down on a year-by-year basis, starting in 2016. 2016, we outperformed our benchmark by 200 basis points. In 2017, we outperformed by 300 basis points. Again, in 2018, we outperformed by 500 basis points. In 2019, we were flat. And then we hit 2020, where we experienced a pandemic of epic proportions, combined with Russia and some of the leading energy nations increasing their supply of energy supply. And so last year was definitely a year that caught us off guard that no one could have anticipated or expected. But let's drill into this 0.7% that our benchmark was up by. Over 53% of our benchmark weight is weighted towards high quality fixed income securities, which is TIPS. And so in a year like last year, where deflation was at the forefront, where rates went down, over half of our benchmark went up by a material amount, completely inconsistent with us making loans to energy-related companies or us making loans to commodity-oriented things. So, again, I believe our benchmark is right over the long term to focus on inflation-sensitive benchmarks. But in the short term, you can have a flight to quality that may bias your benchmark upward, whereas your underlying assets or strategies may experience a dislocation that is counter to that. And then I'll also put into context the down 3.5%. Down 3.5%, I think, is a really, really strong number on a relative basis. And I will feel that as we get our valuations coming in, as they roll forward from September to December, and even moving forward, over 50% of our portfolio has a quarter lag. And so with energy and oil prices being at $61 today, we feel that there's a significant amount of reflation and catch-up to occur in our portfolio. And as we have spoken with all of our managers in the energy and commodity subcomponent, they're actually doing way better than public market comps would indicate. And we have a slide here later on showing you some of the public market comps and things of that nature. The next slide, what I really want to focus on again is starting in 2014, the roadmap for the team was to diversify into real assets and other diversifiers. And as you focus on the 5-year and the 7-year number, you can see that is an outlier. That is really strong, north of 7, almost 6% annualized for 5 years, and also for 7 years, close to 7%. And so that's been great for the plan, for us to pivot and allocate capital towards other real assets and diversifiers. And what's featured in the real assets and diversifiers? It's infrastructure assets, it's royalties, drug royalties, it's cell tower cash flows, digital assets, airports, all sorts of things that have less sensitivity towards deflationary environments. And so, and then as we look in the short term, the 1-year period, you see where the real assets and diversifiers actually has underperformed, down 4%, whereas the benchmark is up 4%. And so that, to me, that also highlights the mismatch in our benchmark. But over a long period of time, these real assets and diversifiers will be accretive to the portfolio. But in the near term, it's a lot of noise in the benchmark. And again, I'm not really worried about the noise in the benchmark on the short-term basis, but to look at things on a long-term basis is what we should be doing. And then you see in the orange, our liquid exposures materially match over 1, 3, 5, 7-year period. They are really in the realm of the corresponding publicly traded benchmark. So if our illiquids are doing well over a long period of time, and then our liquid exposures are really closely correlated to their appropriate benchmarks, I don't really see a lot of issues on a go-forward basis, or just in general. Well, I'm going to move forward to the next slide that I kind of alluded to already. Last year was a year of ups and downs of epic proportions. If you experienced last year, you had a gut-wrenching feeling in your stomach throughout the entire year. But if you stuck your head in the ground like a bird could do and woke up a year later, you would not know the difference between some things that happened last year. Again, pre-COVID, oil prices were north of 60 and hit a low of the front month contract actually went negative. We saw unprecedented types of things happen in the energy markets, and then settled in around $12, and then today we see it back to above $60. And so a lot of the S&P energy names, equity-oriented names, which is a small percentage of the S&P, was down 30% last year. The Bloomberg Commodities Index was down 3.5%, and the Barclays High Yield Energy Index was flat last year. But if you substituted the High Yield Energy Index from Bloomberg and substituted it with Bank of America Merrill Lynch, you'd see that the energy portion of that benchmark was down 6% last year. And I did not want to use Bank of America for this just because we have everything in terms of Bloomberg commodities or Bloomberg benchmarks. But Bank of America Merrill Lynch is a well-respected, highly recognized index to use. And so with our portfolio being down 3.5% and the high yield energy portion of Bank of America Merrill Lynch being down 6%, actually, again, I think our managers have added value, and we can go offline one by one with our managers and our portfolio composition. I want to move to the next slide. Actually, let's back up. I wanted to highlight the quality bias again. The 5 to 10 year tips is up 11% for calendar year last year. Many of our exposures, you cannot expect commodities or anything you're lending to that's sensitively tied to inflation to be up 11% in our space. But anyways, I digress. Go for it. Left side is our long-term benchmark. This is what we think inflation-sensitive benchmark should be over a 10-year plus period. And then the right-hand side is more of an implementation based on the portfolio composition, how it's currently structured today, and being weighted on a bottoms-up basis. And so you can see that, again, that over 53% of our benchmark is based on U.S. tips, with 24% being 1 to 3 year and 29% being the 5 to 10 year tips, with everything else being weighted towards the appropriate infrastructure or energy benchmarks or timberland benchmarks and commodities benchmarks. Moving forward, over 70% of our portfolio is level 4, and that also indicates the fact that a lot of our portfolio is on a quarter lag, which we think moving forward, as new valuations roll in, we'll see positive performance associated with those things. Now I'm going to move to the backdrop, or the inflation backdrop that we have. And when these slides were constructed just a few weeks ago, significant changes have occurred with regards to inflation and the backdrop. But as we were putting these slides together, you can see from the December minutes of the FOMC that from September to December, inflation expectations or uncertainty around growth went down, and also uncertainty around inflation actually went down. And then you can also see that the risk to inflation to the downside actually went down. And we think moving forward, as things that happened this week with Powell's comments yesterday talking about inflation, et cetera, we actually could see inflation on the rise on a go-forward basis with the amount of stimulus that has been injected into the system. Won't regurgitate. Jeff, Chris, and Dan talked significantly about that, but and everybody knows with all the fiscal and monetary stimulus domestically and globally, we feel that there could be inflation on the go-forward basis. We're going to move to the year-over-year changes in CPI. 1.4% at the time of us putting this together, and the break-even rates were approximately 2.1% at the time of us putting this together a few weeks ago, and now break-evens have even soared higher. As Dan alluded to, break-evens currently today stand at almost 10-year highs for break-even rates. And so, that means that, over the next 5 years, the market is expecting 2.35% or better inflation over the next 5 years and over a 10-year period. With the 5-year expectations having a lot more volatility associated with energy prices or changes in energy prices as part of that. We're going to move to the next slide. Although everybody's worried about the labor markets, which we should be worried about the labor markets, we actually think that the labor market is actually kind of tight, given that we've gone through or going through a pandemic. Unemployment spiked to 15%, but we see that back down to 6.3% today, which over a long period of time, 6.3% is actually of unemployment is actually pretty low in my opinion. Unfortunately, there's a lot of dispersion around the unemployment level, so low wage earners actually experiencing a higher portion of unemployment relative to higher wage earners, and you can see that embedded in the numbers in the bottom left corner. When you look at hourly wages and the year-over-year changes, they spiked. Hourly earnings spiked when unemployment was spiking. So you can tell that lower wage earners were actually hit hardest by the pandemic from a income perspective. Want to move forward. Now this slide shows where there's a significant amount of potential for inflation on a go-forward basis. Home price appreciation almost hit 10% last year. Given the low interest rates that a lot of us are experiencing, and if you haven't refied your home mortgage in the last 3 years, I'm doing a public service announcement. You should go run right now and refinance your home to lower your monthly payments. And given the lowest number of supply of houses that we have in the marketplace right now, the supply of homes is near a 20-year low. So inventory is low, and then you actually have low interest rates, which should be pushing up the price of homes on a go-forward basis. And given that CPI is 40% of CPI is housing, I actually see housing being a major factor in the increases in inflation and CPI on a go-forward basis. So this is something we're definitely wanting to monitor and take a look at. Moving to slide 15. This just underscores the wild swing in crude and nat gas over last year, and then also how the changes in some of the inputs into manufacturing and housing has changed over a long period of time, or the last couple of years here. We've seen unprecedented supply disruptions last year. I don't know if you tried to order an appliance or anything like that, but appliances on back order for at least 4 months across the board for a lot of things. Mills were shut down and capacity was shut down, but there continued to be home demand and housing demand. And so you see that lumber prices have spiked accordingly. Also, additionally, the same thing with copper. Several copper mines were shut down due to COVID, and that's causing an increase in copper. So the supply disruptions we see also will positively impact inflation. It might be negative in some parts, but in terms of increasing the direction of inflation, we see that on a go-forward basis. The next slide just shows the money supply and how much that's changed, and the corresponding trade-weighted dollar index. We see that the dollar is going down. We see that there could be import inflation due to the changes in currency. So as you look at it, there's multiple ways that inflation could rear its head, whether or not it's currency, whether or not it's home prices, whether or not it's labor rates. We just see the backdrop for inflation being one to be concerned about on a go-forward basis. And I know everyone's waiting for this next part is what are our views? What are the things that could create a downward pressure on inflation? We're seeing technology advancement creating a downward pressure on inflation. Companies, e-commerce companies having supply chains that are really efficient have brought down the cost of goods and services. So, technology is a way to keep inflation low. U.S. energy independence was a way to keep things low as well. With regards to upward pressure, the weak dollar can increase inflation, supply chain disruptions, as I mentioned, housing demand. All these things on the right-hand side could increase inflation expectations. Moving to slide 18. What are we going to do for 2021? We want to continue rationalizing our current manager lineup, which means focusing on high conviction managers and high conviction opportunities. We want to maintain vintage and strategy diversification. It shows that actually is a driver of reducing risk, being diversified across time. And also we want to make sure that we're adding to strategies that are linked to inflation where there's currently gaps in our portfolio. And slide 19 will highlight some of the gaps in our portfolio. One gap in purple is real estate. We do not have real estate in our portfolio, and that's also to some degree by design because we have a real estate team that also adds up to our inflation risk. But that's an area that we don't have. We have a lower amount of exposure than we'd like to have. Another area is in the technology and data infrastructure space. We do not have a lot of cell tower exposure, music royalties, and other things. Infrastructure is another area where we feel that on a go-forward basis, we should be taking a look at. And then an inflation slide would not be complete without trying to push the limits to some degree. Everybody in the last year has been enamored with how currency and cryptocurrencies and whether or not groups should be investing in those or not. Don't necessarily think that it's appropriate for us yet, but it's something we're watching. It's something we're researching as to how currency in general and then cryptocurrencies might be impacting inflation on a go-forward basis, or vice versa, how inflation may impact some of these other spaces like gold, silver, industrial metals, and cryptocurrencies. All righty, and that pretty much sums it up. Again, this work is not just me, but Ty and Renee have contributed greatly to the success of the plan. And when things got dicey last year, they really stepped up and made sure that we were monitoring and calling, understanding, digging into everything with our portfolio and reporting things in a timely manner. So that's it. And the rest is just appendix slides you can go through at your own leisure. And that's it. Any questions?
Does any members have any questions? Thank you. I'll just comment. Ron spoke about the timber portfolio for a few minutes, and I guess since I've been the treasurer, the board foot price of timber has tripled. But our yield on this portfolio, which is nearly $1 billion worth of assets, has not increased, nor has the value of this gone up very much in the last 15 years. And 15 or 16 years of something not going up very much is, on $1 billion, starts to add up to basis points on the total plan. So I've been very disappointed in what's happening with timber, especially since the price of timber is going through the roof, as anybody knows who's bought a 2x4 lately. I know there are some structural reasons for that, but I'd rather have the price of timber tripling and trying to figure out why we're not participating in that than I would the price of timber falling. So the price of lumber falling, I should say. So just want the Investment Advisory Committee to know that we are zero focused on that going forward, and we'll be reporting back to you as information becomes available. Any questions from board members? Good. We're now to our governance, operations, and investment practice review.
Yep. Thanks, Treasurer. We wanted to give you an update on the results of the governance, operations, and investment practice review that we've undertaken. If you would recall, I think it was at the February meeting last year, we came to you with the proposed scope of services for this project. And as a reminder, this is a review that we are required to do by statute once every 4 years. So the time for us to do that was now. So we undertook that project. We reviewed the scope with the committee last year and got approval to move forward with that. So project took a while, and I'll just give you a brief overview of the results. So you have the slide deck in front of you, and obviously on the GoToWebinar. So we ended up hiring Aon to help us with this review, and as it was a requirement of statute that we do hire a third party, so it wasn't something we could do internally ourselves. So we asked them, if you turn to slide 4 on this, we asked them to review 5 items with regards to our governance, operations, and investment practices. We had them take a look at the current authority, duties, and laws of the department, or of the investment piece of the department. They took a look at some of our main policies and processes. They took a look at 2 specific items within our compliance processes, which I'll go into a little bit. They took a look at our transparency and accountability in terms of how much information we're releasing to our stakeholders and to the public. And then we had them take a look at our ethics and insider trading policies. If you turn to just the next slide, slide 5, real quick. What's that? That wasn't quite in the review.
We don't have that recap from this week.
Slide 5 just goes through a little bit of how the report was developed. Like I said, we hired Aon, I guess, in the second half of the year. Took 3 to 4 months to go through this project. Aon reviewed all the necessary documentation, internal documentation, policies, processes. They interviewed all the pertinent staff, investment and legal staff related to what we asked them, related to the scope. And, you know, we had multiple conversations with them around kind of how we do things and how, you know, they view that versus best practice. So again, it's an independent analysis from Aon. Obviously we set the scope, but just to be clear that this is their opinion, and this is, you know, it was an independent kind of review. So if you just move to slide 7, so this is the executive summary. So overall, you know, I felt like this went very well. If you look at the first paragraph there, the main takeaway of the whole thing was that, you know, Aon feels that our governance, operations, and investment policies that they reviewed that was within the scope was in line with best practices. Several recommendations for enhancements came out of this, which I'll kind of go into a few of these for the next few minutes. But overall, you know, nothing alarming came out of this from my perspective. And I think there's just things for us to consider, and then some easy kind of fixes in terms of just enhancing our policies, enhancing some processes, and some suggestions that they gave us that were very helpful. So look at the first item there, the current authority, duties, and laws. So they took a look again at the statutory language of NCRS and how we govern that. They took a look at the creation of the Investment Advisory Committee, and they took a look at the statutes granting the treasurer independence regarding budgetary authority, personnel, and procurement, and agreed that those 3 items were in line with best practice of how to manage the pension plan and the investments for the pension plan. The one recommendation they did have was the 4th bullet point there around the legal thresholds. So as you're aware, we have statutory thresholds for certain types of investments that we obviously monitor and make sure we're in line with, and we map to our investment policy statement and how we actually manage the assets. You know, you can see in that the second sentence there, you know, those thresholds are currently not impeding our ability to you know, meet our current investment objectives. We're not bumping up towards any of those currently, but they are saying that that is outside of best practice, and that those type of things should be created and monitored within the governance structure of kind of the Treasurer's Office, the Investment Advisory Committee, and then that. So they do recommend that, you know, at some point we look to have that changed, which, you know, we've looked at that in the past. We've, you know, discussed that in the past. And so it's certainly something that's on the radar, but given the fact that, you know, it's not really impeding what we need to do currently, it's probably not something that we're going to be, you know, trying to get to in the short term. Moving to item number 2 on the next slide. So policy and process review. So this was, we asked them to review our 3 main policies. So our main investment policy statement, our investment manager and vehicle monitoring policy, and then our external investment manager and vehicle selection policy. So how we manage the assets in general, investment policy statement, how we monitor these investments, and how we select these investments. Those are the 3 main policies that really drive a good portion of what we do. So we wanted them to take a look at those and make sure that they were in line with what they considered best practice. And, you know, for the most part, that's exactly what they say in these 2 bullet points right here. They are in line with best practice. They offered suggestions to clarify things, to enhance things, and to create consistencies between really the monitoring and the selection policy, but nothing that, you know, we would be concerned with. So we'll go through and, you know, make those changes as we go into our annual process our annual policy review process that we do. In terms of the compliance process review, we asked them to look at two main things. The first one was what we call our conflict wall process. It's how we deal with material non-public information that may be received in one side of our shop, but should be walled off from the folks doing the actual trading. So we've created this process years ago where, you know, we wall off this information, but it was a new process and it's a evolving process. So we wanted to get them to take a look at that to determine kind of if there's any gaps in it or if there are any enhancements that we could be made to help continue to make sure that any risk there is mitigated. So they did offer us some suggestions to supplement what we're already doing. But again, I think, you know, overall, no major gaps there. So I think I felt good about that. The other piece we asked them to look at was the process around our internal equity trading, given that was it's still a fairly new process for us. You know, we've been doing it since, I guess, the end of 2017, but we've never had any review of that process from an outside party. So I wanted to have them review that process. And again, overall, it aligns with what they consider best practices regarding how the processes are implemented and really how the risks are mitigated. They did offer some enhancements, I guess, to the program to ensure appropriate segregation of duties, especially as we consider expanding what we're doing. We may need to tweak some things in terms of making sure, you know, the proper segregation of duties are there. So certainly something we're taking a look at. And again, as we consider expanding what we're doing on the internal equity side, it will be something we look at even closer.
Yeah, I mean, I think tied to that is we'd have further segregation or any additions there would require a little bit of changes in the staffing model to be able to separate some of those more. Yeah,
and it was mainly around the operational function versus the portfolio management function. And some of those are kind of get muddied together on some of these processes, especially with kind of the full index replication that we're doing right now. If we ever, like I said, if we ever enhance that, do active management or enhanced type management or quantitative strategies that are not full index replication, it would be something we'll need to dig into a little bit more and make sure that we're comfortable. But yeah, it would likely require shifting the staffing model around a little bit to make sure that we have the necessary staff and the necessary expertise internally. So flipping to slide 9, the next item here was the transparency and accountability section. So they took a look at all the information that we include on our website, all the information that we provide to the ISC, all the information that's within our audited financial statements. They took a look at everything available to our stakeholders, to the general public. And, you know, they found that, you know, as a whole, you know, we're extremely transparent and you know, which leads to accountability, right? And that it's, you know, we're well in compliance kind of with the fiduciary principles and a solid ethical framework. The other thing they pointed out with this section was that the retained authority and delegations by the treasurer are consistent with other funds that have the similar governance structure, essentially the sole fiduciary structure. So they said that those were consistent with similar type models. And then the last thing they took a look at was the ethics and insider trading policy review. So they reviewed several of our policies related to this. Placement agent policy, political contribution policy, connection disclosure policy. Felt like all of those were exceptionally comprehensive and, again, consistent with best practices. They looked at our ethics policies. We have department-wide ethics policies, as well as we have an investment management division code of ethics and conduct policy that is in addition to the department-wide ethics policies. And they felt like those were extremely comprehensive and are certainly in line with best practice. A couple of takeaways from that when they were digging into kind of the insider trading, and another thing that they recommended, which you'll see on the top bullet point on slide, slide 10. Took a look at the ISC code of conduct. One thing that they recommended, which we'll take under advisement, we'll take a look at, is having the ISC members file our internal statement of economic interest, which a lot of the other boards do, I understand, internally, but not something we've gone down the path of doing on the investment advisory committee. So again, all these recommendations we're going to take a look at and implement the ones that we feel are certainly warranted implementing, and all of these others we'll take a look at, and if they need to be brought back to the ISC, we'll certainly do so. And then the last thing that they looked at again was the insider and personal trading policy, and the policy itself again are in line with our peers and best practices. They did recommend that we review available software utilized to monitor trading activity a little bit more, and they consider best practice to have kind of a dedicated compliance officer or counsel to ensure additional safeguards to prevent any illegal insider trading. So again, that's something we've looked at in the past, and as we've enhanced our insider trading policy, we haven't gone down the route of doing a full pre-trade clearance model, and it's something we'll look at again and kind of determine the benefits of doing that versus the cost and versus the resource constraint of the team and of the department. So that was really everything that, a quick summary of it. There's a much longer report, but that was the quick summary of the review. And again, like I said at the front end, felt it went very well. Nothing really surprising came out of it in my view. They gave us some good recommendations that we will certainly look at and look to implement. And overall, I think, appreciate all of staff's time to put into this, because there was quite a bit of time put in on staff and reviewing this with Aon and interviewing with them. But overall, I think pleased with the outcome. Happy to answer any questions on that.
Very good. Always. It's always good to go out and get a second opinion, especially on issues related to governance, operations, and investment practice review. So, thank Christopher and Jeff and their team for working with these folks. This is something that we do every few years, and we're glad to have the feedback. So, any questions from board members? Okay. Hearing none, we're at part of our agenda for IAC member comments. If any IAC members would like to make a comment.
Mr. Treasurer, Mike Nevin here.
Yeah.
I'd like just to state, as I think I do at each of the meetings that I've been to, what a great job your staff has done in laying out the material, being transparent, very professional. Again, just always amazed at the quality of the work that is put together to create these meetings, and I know how much effort it takes. So bravo again. Thank you very much. We really appreciate it.
Thank you, Mike.
Thank you. Any other board comments?
Hey, this is
Treasurer,
John
this is
Anarella.
Morris. I certainly would like to commend Mike's comments, because you have done such a good job with the reports that we receive, and this itinerary today was very impressive. Thank you.
Thank you, Lars. Mayor John?
Yeah, I apologize. I'm having all kinds of technical problems today, and I had a question going back to the personal trading. And at what level does that kick in? Is it for everybody that's part of the investment side, or just at a high level? But yeah, I'll reiterate, obviously in these trying times, it was a heck of a year to come out and do what the investment committee did this year. So congratulations on it.
Thank you, Mayor.
Yeah, so in terms of the personal trading process, so our insider trading policy is a wider kind of inclusion of all individuals within the department that has information to the NCRS portfolio. So it encompasses not just investment staff. Now, if we went down that personal trading approval process and monitoring process, we'd have to look at that to see what the most appropriate folks to include in that would be. I guess my initial thought would be it would be a more inclusive group that would have, more of that information, I guess. But we would have to take a look at that closely if we end up going down that road.
All right, thank you.
Thank you. Any other board member? Go ahead.
This is Lynn. Can you hear me?
Yes.
Just kudos to the staff. Chris, Jeff, Ron, everybody did a great job. It gives me certain comfort to know in all the craziness the past 12 months that at least we put on the front of cool, calm, and collective, and it shows in the numbers. So great job, guys, and we appreciate what you do.
Thank you.
Thank you. Any other board members?
This is Greg Patterson. I would be remiss if I did not echo all the comments that have been made. The quality of the materials we reviewed today, it's evident that there was a lot of time put in behind the scenes, and the efforts are much appreciated.
Thank you, Greg. Others? Very good. I just wanted to add if you followed the presentation by the IMD department today, as well as the comments by Dan Clifton earlier, you realize that 2020 was so unprecedented on so many different levels, things that have not actually happened in over 100 years. And I think, as Dan said, 2020 was the most volatile year in the stock market, in the history of the stock market. So I want to thank all the staff and Christopher and Jeff as co-CIOs for keeping the trains going, not just on the investment side, but also personnel side and operationally. It's not just about investments, it's about all the above. And I want to thank you. I just want to tell the IAC board members that we are joined in person today by Rhonda Smith and Craig Demko, who are also major parts of the IMD department in terms of their areas that they manage. So I want to thank y'all for being here today. And a couple of announcements on the personnel issues, and I'll let Ben take one, and I'll let Jeff Smith take the other.
Hey, good morning. Just to note that one of the investment attorneys who's been with the department for quite some time, since 2014, Meryl Murtaugh, her last day will be next week. She will be sorely missed by many. She's played an instrumental role in a number of the policies that the Aon team looked at, and also just helped with numerous transactions over the last 5 or 6 years, helped with corporate governance matters. So we commend her and thank her and wish her best wishes as she moves on. And she's pursuing an opportunity here in Raleigh. So perhaps we'll see her around.
I'd echo those thoughts on Meryl as on behalf of the investment team that have all had to work with her in different asset classes and policies and topics and contracts and everything you can think of related to that. We couldn't have accomplished what we did without Meryl's contribution. So we greatly appreciate that. And in addition to Meryl's departure, one of the members of our real estate team, Jack Wilson, is also leaving for another opportunity. He's moving west to pursue an opportunity, and so we will miss that. Jack had a tremendous amount of knowledge. Work ethic was just an example of what we want here at DST, and a positive attitude all the time. So those contributions will be missed. We appreciate what he did while he was with us, and wish him well.
Thank you. And I think Jack obtained his CFA certification while he was working here, did he?
I think so. Yep.
So, not an easy task. Thank you for those announcements. I just wanted to add that, and some of the IAC members are aware of this, that the Board of Trustees of the Teasers and the Elders plan unanimously voted a couple of weeks ago to lower the assumed rate of return on the pension plan to 6.5%. We did this in conjunction with working with the legislature, the County Commissioner Association, the League of Municipalities. It's not hard to imagine that as we lower the assumed rate of return, there's two things that instantly happen. And it's probably the reason why it's only been lowered by one other state treasurer in 62 years. Number one is the fundedness of the plan goes down immediately. No treasurer wants to be associated with that based on a number. But secondly, when you have a commitment not to increase the employee contributions, which are 6% of payroll by the employee, both at the state and the local level, that means it requires more funding from the funders, which are the General Assembly, the League, and the county commissioners, to name the three biggest participants in the plans. So we appreciate the board doing that. We are not trying to lead the nation. We're on anything in this type. There are some plans that have lower assumed rates of return, but there's a small caveat to that. They don't fund their plan. So you can assume any, that's just a small item there. But so when we pull on this lever, and I learned this when we did 5 basis points in 2017, then another 20 basis points later, and now another 50 basis points. When you pull on this lever, you got to make sure if you're intending to fund the plan, you got to make sure all the stakeholders are aligned. So we appreciate you giving me an opportunity. I appreciate you giving me an opportunity to explain that, because it's not just the Investment Advisory Committee. Ultimately, what happens in the IAC and with the investments end up making sure that we remain in the check delivery business. One way to remain in the check delivery business is to make sure that we're fully funded. So thank you. Hearing no other comments, I wanted to open